All right. Hi, everyone. I'm going to be starting a new daily market digest series where I will break down what is moving the markets today and what you should be watching next. So, this video that you're watching right now is the first ever one, and we're going to get right into it from last Friday, which was a beautiful green day for the markets. So, let's get into it. Now, before we go on, right, I would really appreciate it if you could drop a like and subscribe to this video. It will really help me to continue creating such videos for you. Now, if you look at the headlines last Friday evening, right, all of us saw history being made. So the Dow Jones Industrial Average, right, the DJI, finally break its $50,000 milestone. Okay, and you can see, right, is now we are currently at an all-time high, and it looks like a massive victory lap on the surface. But for all of us, right, is looking at the Dow is not sufficient because there are also other indices that we'll look at in order to determine whether the market is healthier or not, right? So the key question is this: is Friday a bullish thing? Right, is what happened on Friday a very bullish thing all the way, or is it what we call a dead cat bounce? Now, so let's look deeper into just these headline numbers to understand the risk. Okay. Now, before that, right, let me share with you something that our President Donald Trump shared, so you can see that what is his target on the Dow? $100,000 on the Dow by the end of his term, which is in another 2 years' time. So you can see, Trump is also very, very bullish about the stock market, and I think that should tell you something about how we should see the next few years. But right now, what about what is happening just last week? Like we saw from last Monday to Thursday, right? It was a very, very red market. Okay. So is this breakout that we see a sign of a healthy market rotation, or is it what we call a dead cat bounce masking an unfinished correction? So this is actually the $1 trillion correction. Now, I'm going to share with you two cases, right? We're going to see the bull case as well. We are also going to see the bear case, right? We're going to see both sides, and you can make your decision to see which one makes more sense to you. And of course, at the end, I also share with you what I'll be monitoring ahead. So the bull case is this, right? This optimistic view that we are seeing is actually a healthy rotation from tech to other industries, which is more balanced, right? So this optimistic view is basically driven by who is leading the charge. So this was not, if you look at how the markets moved last Friday, this was not just a tech-heavy rally, and we saw a lot of strong moves in industrials, in energy, as well in the financial sector, right? Because if a bear market actually happens, if a true market correction happens, right, all of these groups will usually crumble as well, right? Nothing will be spared. So the current strength that we see in what they call the real economy, right, is in a way it suggests that the economy is in a way tapping the brakes, not driving off the cliff. Okay, so it suggests that this engine is functional. There is still not a very big alarming indicator per se. Now, and it's not just the big blue chips that we are seeing, those big industrial energy companies, right? We also saw small caps showing up. Like this is the Russell 2000, which tracks the small caps company. Last Friday, it was up 3.6%, and it's quite a lot for the index. And this is crucial because broad market participation, right, is often that sign of what we call a real market bottom. And when we see the foundation widen, okay, that means when we start to see a lot more companies following the rally, so it will indicate a much more solid recovery. Next, macro data also actually supports the soft landing narrative, right? So you can see that the US consumer sentiments rises to 6-month high in early February. That means what? Consumers are happy. And while even though we've seen jobless claims have ticked up, so they are not at the level where it is very alarming. And this suggests that even though what we saw last week, the SaaSpocalypse, they call it, the software stocks dropping, right? Even though we saw them correcting a lot by 20-30%, right? What we can kind of see it is like a valuation reset rather than a sign of an economic failure. Okay, so this is the bull thesis. But when we look at the bear case, right? Okay, let's flip the coin. We also have to consider the bear case because the market has been fueled by several things which might be concerning. For example, the AI Capex, right? We saw a lot of the Max 7 companies reporting their earnings over the past 2 weeks, and all of their capital expenditure is way through the roof. Like Amazon, the market was expecting 120 billion and their Capex was expected to be 200 billion. Okay, so from what we see now, right, AI is no longer a luxury that drives new revenue. So it has become a costly necessity just to stay relevant. Okay, so let's look at the bear case. But before that, right, if you haven't already, do make sure to join my Telegram chat down below where you can see, you can scan the QR code or you can click the link in the description box down below. So over here is where I share even faster real-time markets insights and knowledge. So free to join, right? So just pause this video here and join me inside. Now, what are the specific issues that we are seeing? So three main specific issues. Number one, the cost to run these models are recurring and it is very expensive. Okay, it is not as cheap as us subscribing to GPT at 25 USD per month. No. Okay, companies are paying like thousands and thousands, hundreds of thousands of dollars to run these inference models. So that's the first one. Second is we are seeing expenses scaling up faster than revenue because it is what we call the AI arms race, right? Is who will actually become the winner at the end. As you can see, right, all of the Max 7 companies and many AI companies, right, they have to continue to spend in advance because if not, right, they will risk falling behind and be obsolete. So you can see this is like that lesser evil, right? They have to spend first and hopefully the revenue will come later. Okay, but this in the meantime, right, these kind of expenses are crushing margins and causing deteriorating operating leverage. Okay, and until the spending turns into what we call actual cash flow, tech valuations will remain incredibly vulnerable. Okay, so this is actually what we are seeing now, these three things, right? And this is an example, right? If let's say people start to feel uncertain about the market, that the valuations are not fair, that the concerns of whether can they actually catch up to the AI race. Okay, so this is actually what happened early last week, right? And even though while we see the Dow rally to $50,000, right? What we are seeing is a lot of software stocks, even after last Friday, are still down from very, very high. Okay, and beyond the economics, right, when we look at the Nasdaq 100, and this Nasdaq actually tracks the top 100 companies that are non-tech, okay, so you can see that less than 50% of the Nasdaq 100 stocks are at above the 50 days moving average. Not less than 50%, sorry, very close, 51% only. So what does this mean? This means the index, right, is being propped up by a few giants while the average stock struggles. Okay, so this kind of looks to me like more of like short sellers actually covering rather than long-term stability. So this is what that concerning thing is about, right? We want to see the Nasdaq 100 stocks above, right, to go higher, right? At the very least to the 70 level. That's where we can feel a bit more certainty as well. Now, we also have to look outside the US, right? Because one of the biggest risks to your portfolio might actually be sitting in Japan, right? And yes, I'm actually talking about the Japan snap election that actually just closed yesterday. So before yesterday, this was a much bigger risk, but the result just came out this morning. And Japan's Iron Lady, the first female prime minister, Takaichi, okay, got a resounding win. So this market risk has really been reduced. So we should kind of see more political stability. We should keep the yen steady. But if we get a policy shock or some kind of shift that suddenly strengthens the yen, then we might start to see that yen carry trade revisiting again. Okay, so this means investors will have to sell US assets to pay back those yen loans, and it will force deleveraging that has nothing to do with how companies' earnings are. So this is sort of like what we call a double-edged risk, but it's very important to watch what happens in Japan because it will flow down to the rest of the world. So I also just did a video about this election, diving deep into this. You can find it in the description box down below. Okay, now where does this leave us, right? So, the Dow 50K is a very nice headline, and strength in what we see in industry does not automatically mean tech has bottomed. So in the coming weeks, this is what I'll be monitoring. So first is NI monetization, right? Revenue growth versus rising costs. Now, we've already seen most of the Max 7 companies reporting their earnings, but some hasn't. And actually, the biggest one hasn't reported, which is NVIDIA. So that is actually coming at the end of the week. Okay. Second is what I call market breadth, like what you saw earlier, participation of the average Nasdaq stock. So we would actually want to see that moving average to be on a higher, like more than 70%, And that's what we call market breadth, right? A lot more companies participating in the rally. And last is global stability, the yen and the global funding markets. Okay, so this is so far is okay. I don't think the risk for this is super high, but it's actually worth to see what Takaichi will do immediately right after she has won the snap election. Okay, so what you see over here is a data I literally just put out a few hours ago. Futures are looking good today. So let's see what happens for the rest of the week. Okay, and to add on to the point about AI monetization, right? Even though most of the companies have reported their earnings already, there are still some this week which I think is important to monitor. For example, Nebius, which is an AI data center. We have Cisco, where there'll be expectations for AI-driven network growth, as well as we have, I think I saw Applied Materials as well on, yeah, I think it's that there's also Applied Materials happening sometime this week. Cloudflare will be worth monitoring for cybersecurity because with more AI, definitely cybersecurity is something that more people will want. Okay, app loving as well. So all of basically everyone that is involved in tech or AI, right? Those are the ones that we want to monitor. Okay, so we want to see that the tech bottom is in before actually like going all in. So on my end, right, I would say that you don't want to be super aggressive at this stage. Look for bargains. There's definitely some strong bargains for great companies today, and definitely don't show hand, right? Patience will be your greatest asset. So that's all for today's Market Digest. Be sure to like and subscribe so you'll be notified whenever the new video releases as well. And I'll see you tomorrow.